All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Friday, everybody. Today's July 12th, 2024, and it's still inflation day. Yesterday was the big inflation day. We had CPI, and everybody was celebrating. Consumer price inflation was lower than expected. Victory over inflation. Our economic plan is working, and the Fed pivot's just around the corner. And then this morning, we got producer pricing index, and oh, that's different. PPI just came out a few minutes ago, and it was high. It was a lot higher. Core PPI was a lot higher. And not only that, it's trending up. And not only that, they upwardly revised last month's. What the heck is going on? I thought inflation was done, dead, vanquished. Where did this inflation come from? Was it hiding under my desk? What? I don't know. So now we have to take a step back from this, okay, now jobs are more important and inflation is done and vanquished situation. We got to look at what's really going on. Inflation is still there, guys. Now it's mainly wage inflation, I think, is what's driving a lot of this. We've seen it in PPIs. A lot of the manufacturing PPIs coming out from ISM and S&P Global. Most business owners still say inflation is their biggest problem. A lot of them are talking about materials inflation, energy inflation, which I don't think is as bad anymore, but I think wage pressures are really adding to it now. The cost of labor, people are sick of the rise in the cost of living, and they're demanding a higher wage. They're leaving their job if they don't get it. And so employers are having to pay up. That's driving up their costs. So the cost to produce goods is going up. But yesterday, we just found out that the cost of buying goods wasn't going up, or it is going up slower, or in the case of the month-over-month number yesterday, was actually going down ever so slightly. A lot of people jumped down my throat for that one. Guys, the data is what the data is. I don't trust the government either. It's all we have to report. But what do we got? Consumer prices going lower as the cost to produce those things go up. What is in between producer prices and consumer prices? That is profit margins, which means profit margins are getting compressed. They're getting squeezed. And we're seeing that all over the economy, aren't we? Target lowering prices, Walmart lowering prices. We were talking about Delta Airlines this week. Their margins are getting crushed by lowering ticket fares, but their costs of labor and everything are still going higher. We got some data from Lufthansa, the big German airlines, essentially saying the same thing today. Inflation is squeezing profit margins now. We're acting like inflation is dead because if the companies raise the price of the stuff they're selling, nobody can afford to buy it, which is true. Consumers are just tapped out. They're going into debt. Credit card debt is still on the rise. Buy now, pay later debt is still on the rise. But people cannot afford higher prices anymore. We saw it from PepsiCo. They're trading down. They're buying the Mr. Pip or the Dr. or whatever, like instead of Dr. Pepper, or, buying that bottom shelf cola instead of Pepsi or Coke. Consumers don't have any money, so they can't eat any new price increases on the consumer front, but the costs for the producers are still going up. Guys, that's very recessionary. That is a very, very dire warning for the economy, in my opinion. And the market simply does not care this morning. Didn't bat so much as an eyelash at that PPI report. And it's the combination, not just higher than expected, trending in the wrong direction, and revisions upward to prior data points. PPI was very bad this morning. So we're going to get into those numbers, talk a little bit about those, and actually show you the charts. You can see it, guys. It's getting pretty bad. Now, on top of that, we got bank earnings going on today. Well, before we even get to bank earnings, we got to talk about what we saw yesterday. A big rotation happened in markets yesterday. After that inflation print came out, that should have sent markets rocketing, everybody anticipating the Fed's pivot and the rate cuts, and oh my God, Zerp and Burr's coming back. But the NASDAQ sold off like crazy, led by the Mag 7 yesterday. Yesterday was the worst day for the Mag 7 in 2 years, 3 years? NVIDIA sold off like 5% on nothing. But there are articles coming out almost daily now. Analysts talking about the AI bubble, warning that AI stocks are overvalued, warning that AI is not delivering any revenue, even though there's trillions of dollars being spent on chips and data centers. People are starting to come to their senses in this AI mania. It's happening very slowly, but I'm definitely seeing a notable uptick in criticisms of the valuations from the business community I'm also starting to see a big uptick in people in the tech community saying, guys, this technology kind of sucks. Yeah, the promise and the rock star CEOs are telling us these things like it's the new fire, the new electricity, Prometheus, born again. What does it actually do? Not very much. So we had a big rotation out of the NASDAQ and to a lesser extent the S&P yesterday and into small caps. A lot of portfolio rebalancing, repositions, but also metals did very well yesterday. They're getting crushed today. That's a whole other story. And now let's talk about bank earnings. JP Morgan came out, Wells Fargo came out, Citi came out. We're seeing some consistent themes in these earnings. First of all, a lot of the banks are making money off of Visa share sales. They're selling stock in Visa. When Visa IPO'd a long time ago, I think it was like 12, 15 years ago, Visa IPO'd. But when they IPO'd, a lot of banks got locked up stock. It was like Class B restricted stock that was essentially on their books as valueless, worthless. They couldn't sell it. And there was a change last fall that I'm not too familiar with the story, but it basically cleared the way for the big banks to sell those shares of Visa that they were holding. And so at least two of the three banks that reported today reported big capital gains from those Visa sales that are skewing their numbers higher. If you strip out that Visa share sale, you're left with net interest income that was disappointing. You're seeing increased provisions for credit losses from some of these banks, but you're also seeing an uptick in revenue from things like trading desks, right? Everybody's YOLOing into call options and NVIDIA and the big tech stocks, right? So the banks are making a lot of money off of that. And you're also seeing a big surge in investment banking revenue. We've seen a lot of mergers and acquisitions in the last couple of months, namely in the energy space. There's been some big multi-billion-dollar mergers in energy, and some of the banks are booking a lot of earnings from that. So we'll get into those bank earnings a little bit also. And last but not least, Japan intervened yesterday. This was, in my opinion, a very sleazy story out of Japan yesterday. The finance ministry intervened in the Forex market. They pounced on that inflation headline from CPI yesterday. There's an article out today estimating $22 billion worth of dollars were dumped on the open market yesterday to try to accelerate that decline in the dollar and increase the value of the yen. Basically, they were stop loss hunting for Forex traders. They were trying to create margin calls in the Forex market. The finance ministry of a sovereign government, the third largest economy in the world, was rigging markets yesterday, taking advantage of headlines to rig markets. How very 2020s of them. We got a lot to talk about this morning, guys. Let's shrink my big melon of a head and get into some of these articles and charts and all that good stuff. Don't forget the like button and don't forget that subscribe button as well, because we do this every morning. So come have your coffee with the melon heads. And the S&P right now, again, shrugging off that PPI read. I mean, here we go at 8:30. I mean, there's a big wick on the chart. You can see it. It popped down, came right back up. The market did not care about PPI. Kind of defies belief, but there it is. Currently up 8.5 points or 0.15% higher. The Dow, meanwhile, is up 109 points. Again, very little reaction to that 8:30 release of PPI, up about 0.25% in the Dow. And the NASDAQ is up as well, a little less than the other indexes, 16 points higher for the NASDAQ, 0.08% higher here. So stocks are up across the board. I think it's a little misguided. Again, what PPI and CPI are telling us is that companies are going to start making less money because of inflation here. The DXY, meanwhile, is down again this morning after getting clobbered yesterday, another 16 basis points lower for the Dixie at 104.28. And looking over at the bond market, we got a mixed bag in yields. It looks like the middle of the yield curve is a little bit lower here, while the two ends are higher. We've got the 30-year Treasury at 4.419. That's up 1.5 this morning. The 10-year's at 4.199. That's up about 0.5%. Meanwhile, the 2-year is at 4.485. That's actually down 2 points. And the 1 month is up a few points at 5.363. It's been pretty weird to see some volatility in the 1 month this week. We started around 5.37, dipped as low as 5.32, now back to 5.36. Unusual to see the 1 month moving like that. And looking over in the commodities board here, we got gold. Spot gold is still over 2,400 at 2,402 and 55 cents, but that is down about $12.50 this morning, about 0.5% lower for spot gold. Spot silver is getting clobbered here, below $31, trading at $30.69 here. That's down about 75 cents or about 2.4% this morning. So giving back all of yesterday's gains and then some. We'll look at that silver chart in a second. Copper, meanwhile, is up about 1.5%. Palladium is down about 1%. I'm sorry, platinum is down about 1%. Palladium is down 3.25% this morning. And WTI crude oil futures for August at 83.45. That's up about 85 cents this morning, about 1% higher for oil. Now, here's the silver chart here. Ugly looking candle right there. That looks like a bearish engulfing right now, although it's still early in the day, so we'll see what we get. But giving up all of those gains from yesterday, Mr. Slammy is in the driver's seat for the time being in silver. Now, looking over at the Bitcoin chart this morning, pretty much more of the same in Bitcoin. At the moment on Coinbase is trading at $57,500. That's up about $150 this morning. So we're kind of still in this range. Now, we got this from, I believe this was Zero Hedge puts this chart out. This is showing net inflows and outflows from the Bitcoin ETFs going all the way back to the beginning of May here. What you can see here is for the last 5 days in a row now, we have had significant net inflows into the Bitcoin ETFs. This is following about a month of net outflows from those ETFs. So the ETF buyers are out there gobbling up Bitcoin again. And of course, when the ETF buyers buy the ETFs go into the open market and buy Bitcoin. So that should be putting some upward pressure on the price of Bitcoin. But we've still got that selling going on from the German government. There's still a lot of talk on FinTwit that the German government is down to their last couple of thousand Bitcoins. So there's still some selling pressure remaining from that government sale that's right now offsetting these net inflows into the Bitcoin ETFs. When the Germans run out of Bitcoin to dump on the open market, if these ETF inflows continue, we should see upward price moves from there. Now let's get into what's going on in PPI here. This is the main story this morning. Producer prices in the United States increased 2.6% in June of 2024 over the same month in the previous year. Producer price changes in the U.S. average about 3% from 1950 to 2024. So here's the big thing, that 2.6%. First of all, that is up from 2.4% in the previous month of May, but the originally reported May data was 2.2%. So they very quietly revised the PPI for May up by 0.2%. And still, we've got an increase to 2.6. Now, also look at the trend here, guys. PPI has been rising since November, December timeframe. I mean, we went from 0.8 to 1.1, 1%, 1.6, 1.8, 2.3, 2.4, now 2.6. Producer inflation is going the wrong way. All right. While consumer inflation is coming down, producer inflation is going up. Companies' profit margins are getting crushed. The stock market does not reflect this reality. Companies are going to start reining in their guidance. We're already seeing it from airlines and we're seeing it from retailers and restaurants. And yet we don't have any kind of movement in the indexes. And remember, guys, these are all the companies that are supposed to spend all this money on large language models somehow that's going to support this AI mania. I just don't see it. And I would also add that 2.6%. That is a big miss. The market was expecting 2.3%. So PPI going in the wrong direction. Now, on a month-over-month basis, it was also a miss. Factory gate prices in the U.S. increased by 0.2% month-over-month in June, following an upwardly revised flat reading in May and above forecasts of 0.1. So once again, upward revision to last month's numbers. All right, they had originally reported a negative 0.2% number for PPI last month. Now that's back to 0%. Now we're up again to 0.2% in the month-over-month number, and that is higher than the 0.1% expected. Another miss on the month-over-month number. Core, same thing. We're going to take out food and energy now. Core PPI in the United States, which includes final demand net of food and energy costs, rose by 3% from the previous year in June of 2024. That is the fastest increase since April of 2023. These are not headlines and talking points that suggest inflation has been defeated. And look at the core PPI numbers, guys. This is even steeper. Now, this is what's even more worrying. When you saw that trend of headline PPI, okay, you could say, well, maybe it's food and energy. Maybe it's geopolitical risk and it's something we can't control. No, that's not what it is, because core is even worse. Food and energy is actually dampening the PPI right now. When you strip that out, you're left with the underlying wage pressures, which is what I really think is driving these numbers higher. And we had a big jump here. We went from 2.6 to 3% in core PPI year over year. Now that's up again from 2.6, but even that 2.6 core PPI reading, that was revised sharply higher. It was originally reported as 2.3. So if you take us to where we were a day ago when everybody was celebrating inflation is over, core PPI was 2.3%. Now here we are at 3%. That is a huge sudden jump inflation, and the market doesn't care. By the way, the market was expecting 2.5% core year over year, and we ended up with 3. Again, big miss on PPI this morning. That's going to crush your margins. And month over month, same story. Core producer prices in the United States, which exclude food and energy costs, rose by 0.4% month over month after an upwardly revised 0.3% in the prior month and above market forecasts of 0.2. So any way you look at it, inflation hurting the producers, but it's not translating into final consumer prices because the consumer won't buy it, which means the producers are squeezing their profit margins. Their margins are getting eaten. That is going to be reflected in corporate earnings eventually. We're already starting to see it in some of the airlines and the retailers. This does not bode well for earnings season, which is now underway with bank earnings starting today. And speaking of those bank earnings, let's get into the first of them. JP Morgan just came out today. JP Morgan notches record profit on Visa gain and deal-making jump. Now, almost all of that record profit was those Visa shares that they sold. And a lot of banks did that. That is a one and done. It's not going to be around next quarter to help them. So, all right, we're going to not pay very much attention to that Visa thing, and we're going to just look at the numbers underlying. JP Morgan Chase reported record profit as investment bankers and equities traders at the biggest U.S. banks smashed expectations, and the firm took a multi-billion-dollar gain tied to a Visa share exchange. Again, so far, they're like, oh my God, it's the best headline ever. Fees from investment banking soared past analyst estimates, jumping 50%. I think that's probably being driven by mergers and acquisitions, namely in the energy space. While the firm's equity traders notched a 21% revenue jump. I think that's everybody, all the shoeshine boys around the world YOLOing in the call options and AI stocks. The Visa transaction added $7.9 billion to second quarter profit. More businesses are doing deals again after a long lull, allowing investment bankers to contribute a larger share of their bank's bottom lines, despite the elevated cost of borrowing, lingering uncertainty posed by the U.S. election, and global geopolitical issues. Despite notching the highest quarterly profit in the history of American banking, JP Morgan's results fell short on a few key metrics. See, now we're getting into the rub here. Net interest income came in at $22.7 billion for the quarter. That's up 4%, but slightly below estimates. So we got disappointing net interest income, which is the single most important data point in bank earnings. While expenses climbed more than expected, higher interest expense, higher wages. That's also PPI. And the bank also took its highest provision for loan losses since the early days of the pandemic. Ooh, wait, what? That's not so good. JP Morgan increasing their provisions for loan losses. Now, last quarter, JP Morgan unexpectedly decreased their provisions for loan losses by $100 million. And I remember in my morning stream saying, guys, the banks are basically manufacturing earnings out of thin air by shrinking their credit losses, which looks like earnings growth on the bottom line numbers. And they were doing it at a time when delinquencies were on the rise. And I remember saying, this doesn't make sense. They're going to come to regret this. And now here they are, where JP Morgan last quarter lowered their credit losses by $100 million. This quarter, they're raising them by $800 million. So the rise in delinquencies, the rise in defaults, JP Morgan is noting that, although everybody's just talking about this one-time thing with Visa shares instead. But JP Morgan stock down a little bit here, 0.84%. It was down 1% and change earlier this morning, trading at 205.71. That's down $1.74. We also got Wells Fargo earnings today here. Wells Fargo pretty much the same as JP Morgan, but worse. Wells Fargo posts a jump in credit loss provisions. That's not the only reason why the stock is falling. Wells Fargo stock was falling Friday after the bank reported a higher provision for credit losses in the fourth quarter and warned of lower net interest income in the year ahead. And again, that net interest income, the difference between the interest they charge on loans and the interest they pay out on deposits, that is getting smaller. We're seeing margins squeezed. See also producer price index, guys, margins getting squeezed. The bank's provision for credit losses was $1.28 billion compared with $957 million in the same period last year. The increase was driven by higher allowances for credit losses on credit cards and commercial real estate loans. There's that rise in delinquencies, that commercial real estate bubble that's supposed to not be affecting the big banks, right? We keep being told the big banks are fine. It's the regional banks that have the commercial real estate problems. Well, here's $1.25 billion worth of credit loss provisions due to credit cards and commercial real estate loans. CEO Charlie Scharf said Wells Fargo has seen a modest deterioration in credit, which it is closely monitoring. And I just love when they tell us they're closely monitoring something. That's corporate speak for we can't do anything about it, but we are staring intently at that number as it goes up. So you can rest assured we're looking at it really hard. However, the bank's new credit card products have increased consumer spending better than the industry average, which has helped improve market share. Now, that sounds like a good data point. Oh, new credit card products increasing consumer spending. But wait, in the last paragraph, they just told us that they're also setting aside higher allowances for credit losses on credit cards because delinquencies are rising. So they're increasing their lending to a risky category, and they're saying, don't worry, this is really good. Okay, good luck with that one. The company's corporate and investment banking segment did particularly well, with revenue increasing 26% from the prior year to $4.74 billion. There's those mergers and acquisitions again. The investment banking is doing pretty well. Net interest income, the profit banks make from interest earning assets like loans and mortgages, was $12.77 billion. That just beat Wall Street expectations of $12.76 billion. The Federal Reserve has raised interest rates 11 times since 2022 to battle high inflation, which has pushed net interest income at big U.S. banks higher. It's supposed to have pushed net interest income higher, and it kind of didn't. It pushed it a little bit higher, not nearly as much as they were hoping. However, as inflation shows signs of cooling, right up until PPI this morning anyway, the potential of rate cuts by the central bank has given Wells Fargo reason to believe 2024 net interest income could potentially be about 7 to 9% lower than 2023's level of $52.4 billion. And it looks like it's that weak guidance for net interest income that's really hurting Wells Fargo shares this morning. Check this one out, down 6.2%, trading at $56.43, a loss of $3.73 a share for Wells Fargo. And I want to send a shout out to my man Frog Capital on Twitter, who's saying Wells Fargo is doing a little worse than Jamie's bank, referring to JP Morgan. A big jump in charge-offs. The storm seems to be brewing. Thank you, Frog Capital, by the way, who's always excellent with his earnings analysis on Twitter, at Frog News on Twitter. You guys should be following him. Here they're talking, he's got highlighted some of the revenue things. Okay, revenue was up 1%. Net interest income was down 9%. Not so good. Net interest income up 19. What are they saying? Non-interest income up 19%. That's talking about their investment banking revenue and et cetera. But it was this one down here. Total net loan charge-offs of $1.3 billion. That's up $537 million with net loan charge-offs of 0.57% of average loans. So we're seeing increases in credit losses. Banks are once again positioning themselves defensively, worried that people aren't going to pay them back. We also got earnings from Citigroup this morning, and Citigroup's earnings were actually looking pretty good here. Citi tops expectations for profit and revenue on strong Wall Street results. Citi on Friday posted second quarter results that topped expectations for profit and revenue on a rebound in Wall Street activity. Here's what the company reported. Earnings of $1.52 versus $1.39 expected, and revenue of $20.14 billion versus $20.07 billion expected. The bank said net income jumped 10% from a year earlier to $3.22 billion or $1.52 a share. Revenue rose 4% to $20.14 billion. Equities trading revenue rose 37% to $1.5 billion, driven by strength in derivatives and a rise in hedge fund balances. Thank you, AI bubble. Roughly $300 million more than the street estimates. Fixed income revenue dipped 3% to $3.6 billion, essentially matching analysts' expectations on lower activity in rates and currency markets. And investment banking revenue surged 60% to $853 million, driven by strong issuance of investment-grade bonds and a rebound in IPO and merger activity from low levels in 2023. So Citi doing pretty good here. None of the bad that really hurt Wells Fargo and JP Morgan. Their stock right now is up 1.35%. ahead of the opening bell, trading at 66.60 and 89 cents. And the last one of the day I want to talk about here, guys, this story really kind of had me shaking my head yesterday. Japan likely spent $22 billion on yen intervention on Thursday. Tokyo tries new tactics to keep speculators on their back foot. In other words, they are artificially rigging markets using the power of the state to pick winners and losers in trades. That's going to end well. That always ends well when governments do that kind of crap. Supporting a firming yen cut amount needed for intervention. Japan likely stepped into currency markets for a third time this year to prop up the yen soon after U.S. inflation figures came out Thursday, according to a Bloomberg analysis of central bank accounts. The scale of intervention was probably around 3.5 trillion yen, or about $22 billion, based on a comparison of Bank of Japan accounts and money broker forecasts. The figures that indicate Japan's currency authorities tried to take advantage of a buildup of expectations for a Federal Reserve rate cut immediately after data showed U.S. inflation cooling broadly. And I can't help but think, guys, that's sleazy. This is a government finance ministry trying to take advantage of the hype around a headline in the U.S. to try to rig markets, to try to trigger short squeezes and stop losses in Forex markets. The suspected intervention on Thursday would be the first aimed at boosting the yen when it was strengthening against the dollar, a fresh development in Japan's strategy of trying to keep speculators on the back foot since it started propping up the yen in September. Some market watchers had already been alert to the possibility of interventions if U.S. prices proved hotter than expected, which could have prompted a yen slump. The likelihood of Tokyo stepping in if the yen started strengthening had not been widely anticipated. The timing of intervention was unexpected, said Shinichiro Kobayashi, chief economist at Mitsubishi UFJ Research and Consulting. They wanted to show they have many ways to intervene as this battle drags on without any clear sign of light at the end of the tunnel. Finance Minister Shunichi Suzuki and top currency chief Masato Kanda, and that Masato Kanda guy, he's new in the job, they both declined Friday to comment on whether they intervened in line with their responses following action earlier this year around the end of April. Local media reported that the authorities had stepped into the market, citing unidentified officials. Now, remember, guys, we talked a few days ago about how Japan had replaced their previous top currency diplomat. Well, I can't remember what his name was, but they're just replacing him. I guess this new guy, he's a little more aggressive because to see them step in when the yen was strengthening yesterday, the yen was rallying in response to that inflation headline, and they stepped in and intervened anyway, making it worse. Very much unexpected there. The speculation of intervention surged after abrupt moves in the yen overnight. In little more than half an hour after weaker than expected U.S. inflation data came out Thursday night in Tokyo, the currency strengthened sharply from around 161.58 against the dollar to 157.44, a move of just over 4 yen on a similar scale to most of the previous interventions. And that is a huge move to happen in just a couple of minutes. Now, I want to show you guys the USD yen chart. Here it is. It's fallen again this morning. Big red candle down yesterday. That was on that CPI report. And you can see that red candle. Let me show you guys on the chart. Here is that intervention from the Japanese finance ministry. And here is the last time they did it over the course of a few days back in May. And you can see we got a similar scale of the move. Now, something else I would point out is they took us down to about the 50-day moving average last time where it bounced. And then eventually the yen just resumed declining as this chart continued to climb. And, well, we kind of did the same thing. We came down to right about the 50-day moving average yesterday. And here we are holding there. So, hey, if you're the Bank of Japan, you could, abandon modern monetary theory, which is a fundamentally insane economic policy that victimizes the average person and benefits the ownership class. I mean, you could stop doing that, or you could become one of these a-holes that intervenes in markets, picking winners and losers arbitrarily, making it impossible for anybody to make an informed, educated investment because you never know what some bureaucrat might do, come in and totally blow up your trade. Well, hey, when a choice is presented between doing the right thing and being an a-hole, government bureaucrats decide to be an a-hole every single time. You can set your watch by it. and the Japanese authorities no different yesterday. And I just want to say thank you so much to Mr. Metal Seer. I appreciate the super chat, the support of the channel. He says, coffee ready. Need a melon mug? Well, check out the merch store. They're down there. And he says, coffee and aspirin combat Parkinson's. Little hint for Brandon. Yeah, sprinkling a little politics in there. We all saw the NATO summit yesterday. I'm not going to get into that one, guys. I try to avoid politics if I can help it. Sometimes politics is unavoidable in finance, but yeah, the cognitive thing, we're all watching that. It's kind of painful to watch at this point. But thank you very much, Metal Seer. I appreciate the super chat and the support of the channel. And Metal Seer also wants to see the Janet. He says, yelling to Japan, don't make me come over there. And don't worry, guys, if you want to intervene in our Forex markets, I really don't want you to sell our treasury bonds because I'm trying to rig our own markets over here with our silly treasury buyback, which is how an imbecile would refinance his mortgage by selling low-interest debt, taking out higher interest debt to pay for it. However, what I might do is maybe we could give Japan advance access to some of our inflation data so that they could intervene in their Forex markets, maybe buy a little cooperation from our rivals over there. Well, Secretary Yellen, whatever you're doing, it appears to be working because interest rates are falling in the States, and the Japanese seemed ready to pounce yesterday when that inflation headline came out. So I don't know if they got a sneak peek at the data or if they just decided, you know what? Let's keep all the traders guessing. Either way, Japan got involved at just the right time and made a fine mess out of Forex markets. And now all the people who know the value of the yen is in decline because they're keeping their interest rates held at nothing. They have to wonder, hey, it's a good trade. It seems like an obvious trade, but at any time the government can come in and blow you up. That is not a free market. That is not a fair market, but it is the market that we live in. Thank you very much, Metal Seer, for the support of the channel, sir. I appreciate that very much. And thank you, everybody, for having your coffee with the Melonheads this morning. Also, shout out to all my Melonheads and Magnanimous Melonhead channel members and Patreon supporters. Thank you guys for everything you guys do for the channel. Links down below, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, we'll be back at 3:15 p.m. Eastern Time today for our weekly wrap-up live stream. And until then, live small and dream big.